What if the biggest financial decision of your life is one you barely question? Not because you've done the math, but because it feels normal. Daniel and Marcus are both 25. They live in a mid-sized city. Could be Chicago, Manchester, Berlin, or Dallas. Not extremely expensive, not particularly cheap. They earn the same salary, $60,000 a year. After taxes, healthcare, and basic deductions, they each take home about $3,800 a month. Their lives look almost identical on the surface. They rent similar apartments. They both finance a car, about $400 a month. Student loans, another $300. Groceries, insurance, utilities, subscriptions, around $1,500. By the end of the month, both are left with roughly $1,200. Same income, same expenses, same starting point. But over the next 20 years, they will quietly build very different financial lives. At 27, Daniel decides to buy a home. Not after deep financial modeling. Not after comparing long-term opportunity costs. He buys because it feels like the next step. His friends are talking about it. His parents encourage it. The bank pre-approves him quickly. He finds a $320,000 house. He puts down 10%, about $32,000. Takes a mortgage for the rest. His monthly housing cost, mortgage, property tax, insurance, basic maintenance, comes to about $2,200. This is higher than his previous rent of $1,400. But mentally, it doesn't feel like an expense. It feels like progress. Marcus makes a different choice. He continues renting. His rent increases slightly over time, averaging around $1,500. Instead of committing to a mortgage, he invests. Not aggressively, not perfectly. He simply takes the difference, around $700 per month, and invests it into a broad index fund. Every month, consistently. No attempt to time the market. No complex strategy. Just repetition. In the first few years, Daniel feels ahead. He owns something tangible. He paints the walls, upgrades the kitchen slowly, talks about building equity. Marcus, on the other hand, sometimes feels uncertain. Renting feels temporary, less stable, less respected. There's no visible asset, nothing to show when people ask, "So, have you bought a place yet?" But under the surface, something important is happening. Daniel's $2,200 monthly payment is not building ownership as quickly as he assumes. In the early years of a mortgage, a large portion goes toward interest, not equity. If his loan is around $288,000 at roughly 6% interest, his first several years are dominated by interest payments. In year one, he might pay around $17,000 in mortgage payments, but only about $4,000 to $5,000 of that actually reduces the loan balance. The rest is interest. This is rarely emphasized, because the monthly payment feels like progress, even when most of it isn't. Then there are the costs no one talks about up front. A new roof after 10 to 12 years. HVAC repairs. Plumbing issues. Appliances breaking. On average, homeowners spend about 1 to 2% of the home's value annually on maintenance. On a $320,000 home, that's $3,000 to $6,000 per year. Not every year evenly, but over time, it adds up. Property taxes also increase gradually. Insurance premiums rise. None of these feel dramatic individually, but together, they quietly reshape the math. Marcus's situation feels less impressive. His rent is predictable. Sometimes it increases. Sometimes he moves. But his costs remain relatively controlled. And every month, $700 continues to go into investments. At a 7% average annual return, which is conservative for long-term equity markets, that $700 per month compounds. After 10 years, his portfolio is around $120,000. After 20 years, it grows to roughly $365,000 to $400,000. No single dramatic moment, just accumulation. Now let's fast forward to age 45. 20 years have passed. Daniel's home, assuming a steady 3% annual appreciation, is now worth around $580,000. On paper, that looks like a strong outcome. He bought at $320,000. Now it's worth significantly more. But the full picture is more complicated. Over those 20 years, Daniel has paid roughly $250,000 to $300,000 in mortgage payments, over $120,000 in interest, tens of thousands in maintenance, increasing property taxes and insurance. His total cash outflow is far higher than the purchase price, and a large portion of that money did not build equity. He does have ownership now, or at least he's close to it. But most of his wealth is concentrated in one asset, one location, one property, one market. If he needs cash, accessing it is not simple. Selling takes time. Refinancing depends on interest rates. Borrowing against the house adds new risk. Marcus's situation looks quieter. His portfolio is now worth around $380,000. It fluctuated along the way. There were years when markets dropped, moments where investing felt uncomfortable. But over time, it compounded. His money remained liquid. He could access it if needed. He could relocate for a better job, take a career break, adjust his lifestyle without being tied to a fixed asset. At this point, people often try to decide who won. But that's not the most useful way to look at it, because both made reasonable decisions. The difference isn't intelligence. It's perspective. Daniel optimized for stability, ownership, control, a sense of permanence. These are not irrational desires. They're deeply human. A home feels safe in a way numbers on a screen don't. You can live in it, touch it, improve it. It integrates into your identity. Marcus optimized for flexibility, liquidity, mobility, compounding. These are less visible benefits, less emotionally satisfying in the short term, but powerful over time. The reason most people lean toward Daniel's path isn't because it's mathematically superior. It's because it feels more certain, even when it isn't. There's also a subtle system at play. Banks are designed to make mortgages accessible. Monthly payments are emphasized, not total cost. You're told, you can afford $2,200 per month. Not, you'll pay over $500,000 over time. That framing matters, because humans think in monthly terms, not in decades. Social pressure reinforces it. Buying a home is seen as responsible. Renting is often seen as temporary, even when the financial difference is not clear-cut. There's also something else happening psychologically. A mortgage forces saving, even if inefficiently. Each payment reduces the loan slightly. Over time, this builds equity. For many people, this structure is helpful, because without it, they might not invest consistently. Marcus, however, relies on discipline. No system is forcing him to invest. He chooses to do it. Every month. Even when markets feel uncertain. Even when there are other things he could spend on. This is where the real difference emerges. Not in the asset, but in behavior. Financially aware individuals don't just ask, should I buy real estate or invest in stocks? They ask, what is this decision going to require from me, consistently, for the next 20 years? Because the outcome is rarely about the asset alone. It's about the structure around it. A mortgage is a long-term commitment. It reduces flexibility. It increases fixed expenses. It concentrates risk. But it also provides forced discipline and stability. Investing in markets requires consistency without pressure. It demands patience and tolerance for uncertainty. There is no monthly obligation forcing you to continue, which makes it both powerful and fragile. If Daniel had taken the same discipline he applied to his mortgage and invested consistently alongside it, his outcome would look very different. If Marcus had stopped investing during market downturns or spent that $700 elsewhere, his results would fall apart. Over 20 years, small behavioral differences compound more than the initial decision. By age 45, Daniel has a home that represents stability. Marcus has a portfolio that represents flexibility. Neither is inherently better, but they serve different versions of life. One is built around staying, the other around adapting. The uncomfortable part is this. Most people don't consciously choose between these paths. They drift into one, guided by defaults, by what people around them are doing, by what feels normal at the time. And once the decision is made, it becomes difficult to reverse. So the real question is not real estate or stocks. It's, what kind of constraints am I willing to live with for the next 20 years? Because every financial decision is a trade-off, not just in money, but in flexibility, risk, and behavior. When you understand that clearly, the decision becomes less emotional, less reactive, and more aligned with the life you actually want to live. If this made you think a little more clearly about long-term money decisions, you can subscribe for more calm, reality-based perspectives like this.